All right. Welcome to the latest edition of the InvestTalk Wealth webinar series. And today I am joined with Luke, as usual. And this is a topic that we wanted to cover because so many people rely heavily on their workplace retirement accounts. And it's important to get it right and to understand what it means in context to your entire investment picture. And so that's what we call unlocking the potential of your 401k. We all have a 401k, and it's about maximizing that. A lot of people just throw it in a target date fund, but that's kind of lazy, would you say?
It is a little lazy, and I just want to say before we get started, it's exciting to be in the same room as you. Typically, we're in our respective houses. We decided to change it up a little bit. So
Yeah,
it's good to be.
Nice studio we have here. So excited about this, and we're excited to bring you a comprehensive investment blueprint that we've put together here. Obviously, we are the presenters, and this is our agenda for today. So I'm going to go over what is a good 401k plan, some kind of trends in the industry, so you understand that in context to your own 401k. And then Luke's going to go over analyzing your investment options, and then I will dig into how this relates to your full financial plan, and then we'll get to a Q&A a little bit later. So let's talk first about what a good plan is. Is your plan any good? Now, I'm talking about 401ks, but it could be a 403b, it could be whatever TSP, whatever workplace retirement account you have. Now, one thing most people don't understand, Luke, is that if you run a 401k plan for your company, you are a decision maker. You have authority over how the plan is ran. You have a fiduciary duty to your clients or to your employees, which we know because we're registered investment advisors. We have a fiduciary duty to our clients, and that means you as an employee could sue your employer if they are slacking in their duty.
Yeah, with great power comes great responsibility.
Exactly. So there's a lot of responsibility, especially when you have a large plan, a lot of employees, hundreds of thousands of employees, et cetera. And so that's something that everyone needs to understand, is that you have some, you have your own authority, right? Mm-hmm. The ability to go out there and analyze your own plan and push them because they need to act in the best interest of you, the employee. So don't think that you are, you just have to lay down and take whatever plan you get, okay? Now, number two is who pays the administration fees? So, 401k plans, they can be complicated. There are plan document fees and management fees. Sometimes it goes to the advisor who's picking the investment options. A lot of times it goes to actuaries and people that are maintaining the plan on the back end. And so there are fees involved with all of that. Now, the employer can pay that and cover all those costs, or they can lay those costs on the employees and spread it out. And so it varies, and you need to know kind of what that is. How much of those fees are you bearing? And then there's what are called the qualified default investment alternative. So these are QDIAs, is short. It's kind of the industry jargon, QDIA. Typically, it's a target dated fund. You have a target date list, and based on your age and when you'll hit 65, they'll default you into the 2045 target dated fund, whatever's kind of closest to that 65 age. Or there could be one particular fund, maybe like a blended fund that they opt you into as well. It's just, hey, if you don't make a decision, here's what you're going to go in, and that could be good. That could be not so good, right? It just depends on what it is. So you have to know what that is if you aren't making any decisions. And then education and planning. So, most advisors, good advisors on a 401k plan, they're earning good fees. They're usually earning about 25 to 50 basis points annually on these plans. And a lot of plans are millions and millions of dollars. So they're well compensated each year to manage these plans. And so you need to understand, what are they offering beyond just picking the funds, right? Beyond just saying, here are the good funds that you should use. It's okay, what other financial advice are they giving you, and education, okay? Hopefully they're giving you some. And then Roth and mega backdoor Roth. So are there Roth options? Traditional 401k, tax deferred, whatever you put in, it's deferred on your taxes. But a Roth option is, hey, I'll pay the taxes now, and in the future I don't have to pay any taxes. So do you have that as an option? Most plans are starting to incorporate that, but you want to make sure that's an option. And then mega backdoor Roth, it can be a bit complicated, but this will allow you to put a lot more into your 401k. So is that an option as well? And then employer match. Typical range, like I said here, is 4 to 6%. Know what that is. We always say make sure you get the full match, but hopefully you're getting some match there. So that's a question of, is your plan any good? Now going back to fees, this is the average 401k fee. I believe this is for 2023. And so what you see is that the smaller your plan is, the bigger the fees on average are, and as a percentage of your assets. So typically between 1.5% and 2% annually that you are typically paying for these small plans. So if you're in a small business, 25 less employees, these fees can be pretty hefty. If you're in a giant corporation, obviously they spread out those fees over a lot of employees, and so they can be pretty low. But know what those fees are. And this is another reason why you want to roll your 401k into an IRA so you can avoid those fees as well. This is on top of the fees that you're paying within the mutual funds or investment options that you have. Okay. Now there's the Secure Act. So there's Secure Act 2.0 kind of changed a lot about about what's happening within the industry. And there's a few major ones. Employers can match for student loans. They can offer emergency savings accounts up to $2,500 annually. You must automatically enroll people in new 401k and 403b plans at about 3% of their rate. So it's kind of that default, not just default investment options, but default deferral that they're pushing past as well. And then long-term part-time employees can actually be part of this. As it used to be, you have to be a full-time employee, you have to work there for so long, and then you get access to the 401k. But now it's part-time employees that work a certain number of hours, 500 hours annually. That's effective next year. And then after 15 years, 529 plan assets can be rolled. Now this is not a 401k thing, but it is kind of a retirement, or I guess more of a college savings plan that can be rolled into a Roth for the beneficiaries. So that's a big change as well. And Roth accounts in employee retirement plans will be exempt from RMDs starting, which was always kind of dumb, right? It forces them to take money out that they're not paying taxes on, so that was always kind of dumb. So that's the main overview of kind of some changes within the industry, as well as understanding your plan, whether it's good or bad. And this is your money. You need to make sure you're paying attention to this and pushing your employer to make changes that are in the best interest of you and your fellow employees.
Yeah, and I think that's a critical piece, because most people think about this next part we're going to talk about, which is how to analyze your options and your allocation and whatnot. But really, it's the fundamental part is understanding what are your rights as an employee and what are the responsibilities of your employer to you as an employee. But let's dive into really first allocation before we start talking about kind of fund analysis. And primarily speaking, there are a couple ways you can think about asset allocation within 401ks, right? 401ks, any retirement plan has a very long investment horizon. And so when you are earlier in your career, you have the opportunity to take on more risk. And then as you get closer towards the withdrawal time, right, you need to preserve that capital. That's when you have more certain cash flows, more certain expenses in terms of what you're going to need to be drawing down that money for. And so one way to think about that is an age-based allocation. And there are several rules. You can see this chart on the right shows different rules. One is your age in bonds. So if you're 20, right, you have a long investment horizon, then you want to be 20% in bonds, mostly in more risk-taking capital growth assets. You could do your age minus 20. You could do your age, any sort of rule that essentially takes you on this path where you are more invested in risky capital growing assets early on, and then slowly glide towards that fixed income towards the end and into retirement, and when you are drawing down that capital. So that's one way of doing it. Another way is a risk-based allocation. That's something that we do for our clients in our investment strategies. One complicated aspect of that is kind of determining what your risk profile is. Because there are people that are conservative. There are people that, even though they're early on in their careers, they cannot stomach losing a single penny. There are people that are risk-loving, people that are willing to take on probably a little bit more risk than they should. And so for us, when we think about our clients, right, we have tools such as Nitrogen where we can fill out a questionnaire and look at our clients' portfolios and kind of assess how their risk profile fits into our investment strategy.
Yeah, and that's one reason why we use Nitrogen, is because there's a connection to the answers of the client and actual portfolio outcomes. Because somebody could say I'm conservative.
Exactly.
But really, they're more moderate or aggressive, and vice versa. So everyone's definition of those words is a bit different. So what we want to do is, how does that truly relate to the actual portfolio that you are building? Now, there's drawbacks to that, right? Because there's the age part, right? Just as the age part has drawbacks because it's not incorporating risk. So it's using all these factors, right? It's not just
exactly.
one.
But most importantly is no matter how you determine your asset allocation, some people like to say your workplace retirement, it's set it and forget it. But I don't really agree with that, right? You need to be constantly rebalancing to make sure that you stay within the parameters of what is right for you based on your risk tolerance, based on your age, based on all of these factors that you assess when you start your plans. And so here's an example of that first option, which is that age-based investing, right? This is Vanguard's glide path. And what a glide path is exactly what I described before. You start with more risky assets and you move towards less risky assets as you get older. And so for different funds, this is going to be for a target date fund. For different fund companies, that's going to look differently. Maybe they have a higher mix of international stocks, emerging stocks, US stocks. But either way, the key here is that when you're looking at these target date funds, what they do is they determine when your essentially your date of retirement is going to be, and then they make that age-based allocation for you. And the important part here is not all of these are the same. Why? Because sometimes this mixture here that you see is going to be completely different. Other times, you're going to be paying way less, maybe 20 basis points for this Vanguard fund, where some smaller fund company that may be your only option as a target date fund is going to charge you over 1%, right? And so the key here is that your options are going to be different. Everyone's options are going to be different. But most of you are going to be different types of funds, different types of mutual funds, maybe some ETFs, and not all of them are made the same. Right? You have stock funds, which offer you that growth potential but are higher risk. You have bond funds, which are more steady, more certain cash flows. You want to be in those as you get into retirement. Maybe you have some balance funds that give you different mixtures of equities and fixed incomes. You could have money market funds that are just giving you that capital income. You can have specific income funds that are invested in high dividends. So the key here is that just because they are mutual funds, just because they're the same fund structure, it doesn't mean it's all the same, right? One thing we're going to talk about is kind of the difference between if you're in an active fund versus a passive fund and how that can erode away your return over time. And so here's an example, right? When people think about the cost of funds, people think about that expense ratio. That's that top number there. So you see for this actively managed fund, it's just over 1%, 112 basis points. Index fund, it's 6 basis points. Why? Well, that's because there's a lot more that goes into managing an active fund than an index fund, right? Index funds typically passively track an index. And because an index, like the Russell 2000, Russell 3000 only rebalances once a year, those funds are also going to only rebalance once a year. You really don't need that many people to run an index fund. You're essentially just copying what is out there by the provider. Now, for an actively managed fund, there's going to be a lot of costs that you actually don't see, because you are primarily focused on that number that is the expense ratio. But that can actually be dwarfed by some of those other costs. You have transaction costs. A lot of people don't know this because with their broker, they can trade for free. But a lot of these funds actually have something called a ticket charge, which means no matter what volume, no matter how much dollar value you're trading, when you trade a single security, be it 1 share or 100 shares, you're paying a cost. And so anytime that there's turnover in these funds, you're going to see a cost. Another is cash drag. Maybe it takes a little bit of time between inflows to implement the investment strategy. That actually is a cost as well. If you're not in an ETF, which ETFs tend to be far more tax efficient than mutual funds, you also bear the cost of other investors' activities. If somebody wants to redeem from the fund, that fund is going to have to raise cash if it's a mutual fund. How's it do that?
It's usually at the wrong time.
And usually at the wrong time, but no matter when it is, it's going to have to transact. It's going to have those ticket charges. You're going to be subject to any of the capital gains that investor is then causing because they are redeeming from the fund. So you see that cost from really other people within those actively managed funds. When you start with an expense ratio of 112 basis points, 1.12%, you end up with a expense ratio that's actually closer to 4. So it's really important to understand that you need to dig deeper in terms of those costs that are borne from those funds.
Now, I do think that's a bit of an extreme example, right?
It is certainly an extreme example because
it's rarely going to be this wide, but there can be.
So I will say this though, having worked at a company that did manage active funds, it actually can be this extreme. because there are, but a lot of it is going to depend on that turnover, right? If you have a fund that's turning over 400, 500 times, a momentum strategy, you are going to have implicit costs, is what we call them, the ones that are not explicitly stated. You can have implicit costs that are 3, 4, 5 times what those explicit costs are.
Yeah, so this is probably one that's a hot fund, right? A tech fund, something that there's a lot of money going in and out, a lot of transaction fees, a lot of the bad investor behavior, et cetera. So, but I think the point here is that you have to kind of see what those, what the different costs are compared to like an index fund.
Absolutely. And so what are some key factors you need to consider when selecting these mutual funds? Well, one is certainly performance. Now, they always say, and I agree, past performance is not indicative of future results, but you should be looking at historical returns versus benchmarks, right?
Yeah.
Performance isn't
and not
always
just the S&P.
Yeah, but performance isn't always going to be positive, right? Yeah. The key is if you are invested in a fund, a large cap value fund, a small cap value fund, they're trying to deliver an asset class to you. So what you need to be concerned with is how is that fund performing relative to that asset class? Choosing an appropriate benchmark is one of the most important things. If you want to invest in US small caps, you should not be benchmarking to the S&P 500. That is a large cap index.
Exactly.
So key to performance is not just how the fund is doing, but how it's doing relative to the asset class that it's trying to deliver. One we already talked about is fees, right? You should be looking for fees that have lower relative expense ratios. Now, that doesn't mean you can't be invested in active funds, and you should not expect to pay 5 basis points for an active fund. But if there's a fund that's charging you 2, 3 basis points with a comparative historical performance that is poor, that's not a fund you're going to want to be in.
Yeah.
Another is diversification. You're asking for an asset class to be delivered to you. You want US small caps. You want international large cap stocks. Well, are they doing it? Are they just buying a couple stocks that are within that asset class? Is it actually representative of what you want? That's a key consideration there. And another is something we talked about at the top, which is your risk level. Does it actually fit within the parameters by which you have set for yourself based on your own risk tolerances? And so if you look on the right, you'll see a couple examples of some complicated, kind of looks convoluted, very mathematically language-oriented ways to assess a fund. But the key here is with all of these, the way you are looking at how the fund is doing is how is its return relative to the market's return, but how does that compare to the level of risk and volatility it's taking on?
Yeah, and that's what's so important is some people who chase returns.
Yeah.
The average person who has a 401k, I've seen these meetings, right? I've done these onboarding meetings, and they hand out some collateral, and there's a fund list, right, that's available, and I'll have trailing 3-month, 6-month, 1 year, 3, 5, 10, 15-year returns, and usually most people, they don't know what they're doing. They're gonna, this is before a targeted funds typically, but they would go and they'd say, okay, what has the best 5 or 10 year return? And they pick those. And that's ignoring, like you said, the risk involved, as well as the current valuation of that particular asset class as well.
Yeah, and here are 2 different ways that we kind of look at some funds through Morningstar. This is an example of one particular ETF that shall not be named, but either way, essentially what you're looking at on the left
I think we should name
it's the ARC fund.
It's the ARC fund.
Doesn't do particularly well, but when you're looking on the left side, what you're seeing is, 1 month, 3 month, year-to-date, 1 year return, but you're also saying, okay, what is the quartile rank? How does this rank within other funds that have a similar investment strategy? What are some of these ratios that I should be looking at? So you're looking at longer term time horizons, but getting back to that key performance area that I talked about, which is relative performance compared to what you are trying to actually target. And so on the right, you see more data you can look at in terms of performance. One thing that I want to particularly key in on is towards the bottom, right? Your upside downside capture ratios. So what that means is, well, if the market is doing well, everything tends to do well.
Of course.
But how much of that performance are you capturing on the upside? That's certainly important, right?
Yep.
If you have a fund that is capturing 110% of the upside of the market, fantastic. But also equally important, and maybe more important, is what's that downside capture?
Yeah.
When the market's down 1%, are you down 140%? So if you have a fund that the upside to downside capture ratio is less than 1, you're kind of losing out there. It's not operating really efficiently within its risk parameters.
Yeah, it's kind of like beta is a simple way to calculate, the correlation of the market. If beta is 1, that means it tends to go up the same amount or down as the same amount as the market. Where this is a little bit more targeted, it's okay, what is your beta on the upside and what is your beta on the downside?
Exactly.
If your beta on the downside is larger than your beta on the upside, that's a problem. And you can see with ARC funds, its downside beta is 1.95. Its upside beta is 1.21.
Yeah, it's not good.
That's not good. And that's why if you look at the 5-year returns in the lowest, it's 99%. Less 1% of funds have done worse than this. 2.7% over the last 5 years, where the category is done 10.5, and the index is done nearly 12.
Yeah.
That's how bad this fund has done and how poor it is. And these are, once again, extreme examples, but it tells you, how to really assess these funds.
And I think the reason why I wanted to include this is because people still throw money in it, right? And so the key here is you can't get stuck on a 1-year performance number 3 years ago and expect that because it was doing very well back then that it'll be doing well again. You have to look at a long performance horizon.
Look at 1
month. You have
month.
to compare it. Yeah.
It's a 2%. It's done great in 1 month. 6%. But compared to the index that's done, 3. So it's done double the index in 1 month, but that's 1 month. It doesn't really mean much.
Exactly. So I hope that kind of gives you a little breakdown of how you might start thinking about what types of funds that are available to you fit within your parameters of how you consider yourself in terms of your risk tolerance, where you are in your age, and can help you further prepare for your retirement down the road.
So what I'm going to do is, we just talked about the funds that are available, how to analyze them, if your plan is good or not. But frankly, that is just a very small percentage of. Actually, let me do this first before I get to that. So that's a very small percent. I wouldn't say percentage. It's a large percentage for most people, but it's not the only thing to consider when you are trying to build out a successful financial path. And this is something we do for clients. And these are some pieces to a successful financial plan. I'll show you how we do it in a minute, but this is just a broad overview. So the first is tax diversification. One of the issues with a 401k or a traditional IRA, any money that you are contributing to these accounts, you're writing off in your taxes, it creates what we call in our industry a deferred tax liability, which means in the future, you will have to pay taxes on that money. Now, there are strategies to reduce that, Roth conversion strategies, which I talked about here second, but that's based on a lot of tax assumptions and where your tax rate is today versus the future, et cetera. And so that's number one. Gotta go get my charger. Forgot about that. The second is income and expenses with inflation expectations. So it's not just looking at your budget today, but it's okay, what's your budget 5-10 years from now with your income growth, with inflation, et cetera. And then what are your other assets? What's your real estate? Do you have pensions? Do you have other businesses? Maybe a side business? Do you get deferred comp or stock options, things like that? How much does that incorporate into your plan? And then Social Security strategy. Should you take it at 62, 65, 67, wait all the way to 70? All that is very important. And then you have different goals. So retirement is always one, right? That's what the 401k is about. But we all have different goals, right? We want to pay for medical expenses in retirement. Maybe we want to buy a bigger house, a second house, a vacation home, a boat.
Some people like boats.
Some people like boats, right? You maybe want to pay for the education of your children and grandchildren, for example. And then an emergency fund. Most people should have that. They should have an emergency fund, 3 to 6 months of expenses, et cetera. So developing that plan is certainly vital. Luke, you want to go grab the charger?
Yeah, I'm going to.
What I'm going to do is I'm going to launch into this demo real quick. And where are we? So this is, okay. This is just a demo. You can see top right. This is a demo. This is our software that we use for clients, and it's really powerful because it incorporates all of these things. So we have personal info. This is Joseph and Jane. This is their income. This is Joe. He was only one working. He has a 2% income growth per year, but he's going to retire soon. These are their expenses per month. You can itemize them per category. I'll just put a dollar amount in there. We can have different goals. So we talked about that. Retirement. They want to travel. So they have a travel budget, and they want to travel 2 times a year for the next 10 years at $12,000 per trip. They want to pay for their daughter's wedding. They have an emergency fund of $35,000 that they want, and you can automatically estimate healthcare costs. And they want to they want to downsize their home. Okay. So those are different goal settings that we put in. You can earmark all of these are the accounts that they have. You have investment accounts. You have Roth IRA, 401k, 403b. You have their mortgage here, which is only about $50,000 left, which is good. And then you earmark these all for the different goals that they might have. This is their CDs and savings accounts, et cetera. Then they have their residence. So incorporating this, do they want to sell the asset, say in 2027, for example? That's when they want to downsize. for example. But you can see, what the market value is today, what is their property tax, what is their homeowners insurance, because remember, these are also indexed to inflation as well. Taxes are going to go up, homeowners insurance is going to go up. We see that with Florida, right? So, indexing those things to inflation. And then ultimately it creates something that looks like this, where you have employment income, he's retiring in a couple of years, right? When are they taking Social Security income? For her, it's Jane now, but he's waiting all the way till 70 to maximize his payout because he was the breadwinner there. And then you have distributions, where's the money coming from, savings accounts, IRAs, et cetera. And then taxes, automatically calculating taxes each year going forward. Property taxes, you see they're selling that property, they're going to buy another property, et cetera. So you can just see here all these different things, living expenses, indexing that to inflation. What are they going to spend now versus what they're going to spend in retirement, for example? And then are they contributing to anything? So this is when they downsize their home and they're getting $750,000 out in order to invest. So this all creates something like this, where you have each year total account value, employer match, contributions, and investment earnings. And then you can see kind of how that glide paths for the next 10, 15, 20, 30 years until full retirement age. And then you create a retirement map. This is something that we do. You run Monte Carlo simulations to see, okay, are they on the path to success? They're at 99%, so they're in a good place. But there are other things you can do, like when are they taking Social Security? Are they maximizing their assets, maximizing their benefits? And this is all, let me actually get to the last part with the Roth conversions, which is saying, okay, I want to convert at a certain tax rate, right, at retirement and stay below the 22% tax level. And then there's these dark blue lines here where it says, okay, this is when you should do a Roth conversion to lock in low tax rates. And this is how much they're saving, about $500,000 in taxes in their full life. So that's what this tool does. This is just one tool. There are a lot of great tools out there. And this is where I say, if you have a 401k, your 401k advisor should be giving you something like this, okay? Something that feels like this. Obviously, this is very powerful. This is called Orion Planning. This is part of our clients' login, see everything, see their 401k if we're managing that, see all their investment assets, et cetera. But this is just a quick example. Once again, this goes very deep. There's so much more I can get into with this, but it is a very powerful tool that will start to incorporate a lot of what your 401k is to you with the rest of your financial life. Because yes, it's the number one place that you're going to save, but it's not the only way to create wealth, to build wealth, and manage your wealth, et cetera. So I wanted to highlight that because it's a really powerful tool that certainly everyone needs access to in some shape or form. Now, going back to our presentation here, I want to talk a bit about something that we launched earlier this year. It's been really exciting and something. It's really kind of the holy grail. I've been doing this for nearly 25 years now, and we've always talked about how do we help clients with 401ks, 403bs, 401as, 457s, et cetera, because we're kind of locked into these investment options, and we can't efficiently manage these plans that have different logins, et cetera. And we now have a piece of software that allows us to do this. So it allows us to analyze investment options, export all those to our system. Luke had that chart of the upside and downside capture ratio, the what's their performance compared to their peers in their particular slice of the market, and we can export that to that software and analyze that very quickly and very easily, and then create a risk-based allocation. Luke talked about that. What is your risk tolerance level? What is your risk number in nitrogen, for example? We have it's 1 to 99 scale. 80 is the S&P, for example. But where do you land on that? And is the 401k invested alongside that? That's one issue with the target date funds is, yes, it's based on your age, but as you said, everybody's different, right? Some people are 23 and conservative, right? Others are 73 and aggressive, right? So that target-dated fund doesn't really account for that, and so that's something we do. It's pretty low fee, only 25 basis points a quarter, and the studies show that if you can have good management of your 401k, it can mean up to 3% better performance each year net of fees, so we can analyze. We're analyzing the fees, we're analyzing the broader performance, analyzing the current trends in the market, and adjusting the allocation accordingly. So that's something that we launched this year. So if you ever want to do a portfolio review, we do it via Zoom now. So you're all logged into Zoom, know how to use that. So no obligation. Review your goals, concerns, and figure out the breakdown of the weightings in your current portfolio. It looks something like this, where you can see different sectors that you have. Are you overweight bonds, underweight bonds, underweight domestic stocks versus foreign stocks, for example. So all of this is do a deep dive into everyone's portfolio. We have different strategies that apply more towards your traditional accounts, 401k, IRAs, Roth IRAs, trust accounts, brokerage accounts, etc. And then, so if you want to get in touch, this is how you do it. Jot that down, reach out to us, go to investtalk.com, click on the portfolio review button, and we can kind of go over all of this for your particular situation. Now we're going to get into a Q&A now. Luke, why don't you read the questions?
Okay. How will I even see them?
I think over on Riley's computer.
Okay,
there you
fair
go.
enough.
Yeah. Or Shelby.
Or Shelby.
Or Shelby. I think we're gonna, we'll let Luke be the decider here. What I'll do is, Riley, unshare my screen. Okay. I'm gonna go to. Give us a minute. Feel free to.
Yeah, we're trying to figure out allowing submissions. So why don't you go over a quick overview of the market today?
Okay. So what I'll do is I'm going to share my charts real quick. Let's take a look at the market today. Want to share my screen, Riley? So while we're getting that ready, I'll kind of go over the market right now, and I think it's important to understand this in context to this full year. We're an uptrend, right? Here's the S&P, pretty decent day today, getting a little near-term volatility, but frankly, this is chop. It's really important to understand that what we've had over the past couple months is a choppy period, but this is normal, right? We had a much worse period last summer. Late last summer into the fall, and then we had that inflection higher. And if you zoom out on the S&P to something that is that's something broader, right? This was just a normal pullback, didn't break any. It's still a higher low, right? And we still are seeing that, and so you have to respect that. So many people try to predict a market crash, and they think that there's going to be some major problems on the horizon. And yes, on the horizon, there's always some sort of major problem. But frankly, this is a very minor bout of volatility recently. Overall, you have bank lending, and I'll show you this. This is something I really love talking about because it's so important. Because there are two ways that money tends to get in the system. Most people think it's the government. Most people think it's the Fed or the Treasury that's pushing dollars out into the system. And the reality is it couldn't be farther from the truth. Now, are they important? Yes, they certainly are important. But it's not the only aspect that is important when it comes to liquidity. And broad liquidity is what really drives the equity markets asset prices forward, right? If banks are lending, that's something that is very important for the financial system. And so they're the ones that are creating the dollars in a fractional reserve banking system. And I'll zoom out here. This is year-over-year growth of bank credit. And so what you can see is during the crash in 2008, this went deeply negative. But as of late, you can see this is now headed higher. So banks are lending. When lending growth is positive and trending higher, that tends to be good for overall liquidity. So you can't really be too upset about that. Are we ready for questions?
Right here.
Oh, we do have
our first Zoom webinar.
This
And
is
the question is a little bit different. Why don't we start with the question from Alex that says, is there any purpose for international investments within the 401k equities since they underperform U.S. equities and no longer keep you diversified as they don't move in opposite directions? They are not inversely correlated as they once were. You want to kick that off?
This is a great question. I kick this back to recency bias, and so many people have that. Now, is it time right now to go out and buy foreign stocks? No, I don't necessarily think you need to be in a rush to do that. But to just throw that forever to the side because for a 10-year period they drastically underperformed domestic stocks, I think is crazy. Because there will be at some point where one of the big drivers here is that there is a lot of foreign direct investment in the United States because of geopolitical concerns, right? China slowing down. There are a lot of issues overseas that are really driving a lot of money, not just domestically into domestic markets, but foreign investors into domestic markets. At some point, though, that will reverse, and the catalyst could be maybe it's a political instability in the United States. We have a very contentious election coming up here. There are a lot of catalysts. Maybe it's the dollar decline, right? Our debt gets too large and the dollar has to be devalued, and suddenly they don't want to be tied to the devaluing dollar, and now they move their money overseas into other assets. So today, do you want to do that? Not necessarily, but I don't think that you write them off completely forever.
I would also say that there have been periods of time where bonds have outperformed stocks, where cash has outperformed stocks, where bonds and stocks have been very correlated. Would you say that those are not diversifying assets then? No, it's just taking a little slice of a time period and understanding that over the long term, there are different dynamics that drive different markets, and that's what causes correlations. Now, certainly international equities and US equities are going to be more highly correlated than US stocks and bonds, but it doesn't mean that they are perfectly correlated. It doesn't mean that they can't be good sources of diversification, and in different time periods under different conditions, that they can be good sources of higher expected returns than US equities.
Exactly. Okay. You got another one?
Yeah, let's do it.
All right.
Let's see. It says, do you do defined benefits plan and actuarial services?
We do not.
That was a quick and easy one. If your salary exceeds the IRA limit to contribute into a Roth IRA, can you talk about how you can contribute to a Roth 401k? What is the benefit of contributing pre-tax dollars, or can you contribute to the Roth 401k with after-tax dollars beyond the 401k pre-tax limits?
Ooh. Okay. The Roth 401k I believe does not have income limits, so that's one benefit of the Roth 401k. Let's see what. What's the benefits of contributing pre-tax dollars or contribute to the Roth? Well, the benefit is tax diversity, right? To be able to in retirement have both. That's what we talked about with that plan, right? It's a part of Roth conversions is locking in those at an advantageous rate, and then have the flexibility in retirement to say, okay, maybe I sold my house and my income's higher this year. I want to take from my Roth versus my traditional IRA, for example. So I think it's always good to have a little bit of both.
Yeah. See, what if you have many cash-like assets and are looking to move more dollars into stocks or bonds with cash valuations so high? What strategy would you recommend? Well, I would start by saying it's always an all-time high until there's another all-time high, right?
Yeah.
Historically speaking, empirically speaking, you have a higher chance of outperformance if you invest at every all-time high of the market compared to every other trading day.
Yeah.
And so what you have to look at is what is the environment in which you're investing. And although there are certain areas within the market that are a little bit bloated, it still seems, based on what's happening within the US economy, based upon what's happening globally, that the path of least resistance is still upward, right? You say it all the time. What's better than timing the market is time in the market.
Yeah, and I see this all the time. I talk to people. This market's at all-time highs. I don't want to put money in. I don't want to do it right now. Because the market's too expensive. Market's too high. And guess what? It just continues to make new all-time highs. And you don't know that yes, at some point there will be, I say it's a deflationary event where brings asset prices down. but that could be easily from much, much higher levels in equities, and that next bottom could be much higher than we are here. You don't know that. You don't know, especially when you think of the path of policy. The path, like you said, the path of least resistance is higher because the path of policy is higher. Look what the Fed just did. They pivoted to a dovish stance with the inflation rate at 2.5%, 3%, right? That would have been crazy 7 years ago. If they saw 3% inflation, they would be tightening policy, right? And so that is an inflationary environment. That's what we talk about. We're in an inflationary environment where they move the goalpost. You know, it's not just about a 2% inflation target, but it's averaging 2% inflation over an extended period of time, et cetera. And they'll continue to move the goalpost because they need to keep the Treasury solvent, and that's what's most important. And so, you know, don't be looking at all-time highs in stocks and being like, oh, I need to sell or I can't get in or anything like that. That's too myopic. Right?
Yeah. Do you do estate planning for your clients?
So we use Trust and Will. It's a great online platform, and for our larger clients, they do qualify for Trust and Will to be paid for. So if that's something you want to talk about, schedule a portfolio review, and we'll do that.
Since the Fed just did screen's a little far away.
I know, right?
Since the Fed just did a rate cut, I was told it is common that after the first rate cut, a market crash will happen in 3 to 18 months. Do you think this will happen, and is KPP planning for this?
No, we're not. Now, could there be a change in market dynamics? I'd say next year at some point. Sure, but a lot depends on who gets in, who wins the election, what they're able to get through Congress when it comes to spending. We have the debt limit coming up here next year, early next year. That's actually going to be bullish. Why? Because the Treasury is going to spend down the Treasury General account. It's going to push liquidity into the economy. And so that dynamic is, at least near term, going to be stimulative. And so between now and at least probably mid-January, you're probably going to see a positive environment for equities. So when you sit there and use these past as prologue for the future, it's I don't say this time is different, but we're certainly in a different environment, and it can be informative, but it's not necessarily instructive.
Yeah, I would say two things there. One, you have to look at the reason why the Fed is cutting rates, right? If the Fed is cutting rates because there's a credit meltdown that's going to swamp the entire global economy, then yeah, there's probably going to be a recession within the next 3 to 18 months. If the Fed is cutting rates because they did a pretty good job beating back a high inflationary time, and they're kind of worried about a labor market slowdown, that's a completely different scenario. And so the other part that I want to mention is, well, it depends on what your definition of a crash is. We're always prepared for 10% pullbacks.
Yeah.
Right? We always are prepared for a time when the market is pulling back and when we can invest for our investors at more advantageous prices. But you can't let your recency bias and your fear of a 2008-like scenario, which doesn't happen all that often, kind of color your expectation of what a market crash looks like. The market's always going to be pulling back. Is there always going to be a catastrophe that's threatening to collapse the entire global economy? Not so much.
Yeah, I don't think that's on the horizon, because I always say this, everyone has PTSD from '08. People still have it, right? We're 15, 16 years on. People still have it because that was the most substantial economic event in most people's lifetime. But what they have to understand is, also has PTSD, those that are in power, those that are at the Treasury, the banks, the Fed,
credit
etc.
agencies.
They want to avoid that like the plague. You think this inflationary environment is bad for politicians and those that are in power? Yes, but we know it's far worse. People are losing their homes when banks are going under, and there's this massive deflationary environment that '08 really was. And so you see this time and time again. Not only is the Fed err on the side of easing, right? They did the QE, and they kind of stopped QE. The market got a little wonky on them. What did they do? QE2, right?
Yeah.
And then you have and then you go all the way to the COVID crisis, right? They just threw everything in the kitchen sink. They're not supposed to buy corporate bonds, but what do? They kind of massage the rules and basically finance the Treasury to buy corporate bonds, right? So they found ways to solve issues, just like Silicon Valley Bank, right? BTFP program. They're going to paper over the problems, but that ultimately is going to create a more inflationary environment. So when they are doing that, they also have PTSD, and they're trying to prevent an '08. And so when people have that in their mind, the bigger risk actually is an inflationary spiral more than a deflationary bust. That's that's the biggest risk in my mind.
Okay. Let's see. For people over 200,000 annual income, can one contribute to a Roth IRA? Is there an income limit for Roth contributions?
Yeah, there is an income limit. It depends if you're married or single. 200,000, I think, is over the limit if you're married, and I think it's still under the limit if you are single.
Yeah.
But that's more of a tax question for your CPA. I haven't looked up those in a second. They change every year too. So.
Let's see. Where can I see your portfolio performance? Is it public info?
No, we don't have public performance info for a couple of reasons. One is every client's assets are segregated. They have their own accounts, IRA, trust account, Roth, etc. So everyone's a little bit different. We have different fee structures based on size, so the fees can be slightly different. And then also, some people are putting in, some people are taking money out, some people are not putting any money in, right? Just keeping the amount in there static. And so that can kind of change the performance per account as well. What I typically talk about clients is general ranges that we return each year depending on the strategy. So that's what I kind of talk about that when we do the portfolio review.
Can you explain return on capital versus income? Return on capital is more tax advantageous. Do you have investments that use this strategy?
Do you want to tackle that one?
Well, I think probably what he's referring to is thinking about capital returns in terms of growing your assets versus like a dividend equity income focused strategy. And yeah, there are benefits to longer investment horizons that don't necessarily take into consideration dividends. Why? Because long-term capital gains are more tax advantageous. And so within all of our strategies, I think you can't think of it, in my opinion, in terms of how much you're paying in taxes, right? What you should be thinking of it is in terms of how many new dollars are coming in. Because sure, maybe you're paying 35% on securities lending, for example, but you wouldn't have had that other 65% otherwise. So it all goes into a holistic approach to how we invest, but all of our investment strategies, certainly on the equity side, are focused on that capital growth and also taking into consideration what a dividend means for the companies that we're investing in, right? Not just what are high dividend paying companies, but what companies have sustainable dividends. Companies that tend to pay dividends tend to be more mature companies that have more sustainable revenue streams, more sustainable profitability. And so that's just one of the pieces that go into all of our equity strategies.
You want to do the last one? When the Fed lowered the rate, was that a political move for Harris, in your opinion? I do actually think it was a political move, but I don't think it was for the current, our presidential race. You know what I think it was for? I actually think it was for China.
How so?
We've never had this discussion. Because I think that, Yellen did visit China recently, I want to say in the last few months. And if we're tightening policy or keeping our rates high, and the China goes and stimulates like they just did, that's going to really crush the currency, right? Whereas if we're both, gives them more room to stimulate, in my mind. So I think this is actually more of a bit of a gift to China and allowing them to stimulate an economy that needs to be stimulated in some way. So that's where I think the motivation was, not necessarily our presidential election.
Well, here you can see some live disagreement. Because
I
I disagree with this because typically the Treasury and the Fed is segregated in terms of their policy. Otherwise, you'd see a lot more collusion. So just because the Treasury Secretary is going to China, I don't necessarily agree that means that the chairman of the Fed and the board of the Fed is going to be cutting rates. So I would say, is it a political move? Probably not. I mean, generally speaking, right, think about it this way. Is the intermediate effect going to be that great such that it would help consumers and think, okay, well, maybe I like the Biden economy more? Probably not. Look what happened to mortgage rates. They immediately dropped and then they went back up. The 10-year dropped and then it started going back up. In a way, it kind of is a gift to the next administration because you're protecting the labor market, and a year from now, whoever the president is can point backwards and say, you know, labor market's been great in my first year of the presidency. I think it was a necessary move because essentially what you had is you had a long period of rate hikes that did a very good job at dealing with the burst of inflation that we had. And so the Fed has to be more concerned about the labor market now. They just absolutely have to be. And again, down a year from now, year and a half from now, whomever is president is going to be probably pretty happy that the Fed decided to start cutting rates.
And I think if it was political, they did a bad job at it because what did rates do? Rates went up.
No, exactly.
Right? And so obviously they weren't in their prognostication of where rates are going or where policy is going, it was not dovish enough. And so if they really wanted to juice the markets near term, then they would have had a more dovish policy that aligned with what the market was expecting, which they did not. And let's look at equities, since equities have been kind of sideways since the announcement. So I don't think it's something that was political. And if it was, they're terrible at it. So I think do we need to scroll down, or do we have one?
We have one that we accidentally missed, and because it's so large, we may get closer to you all. It says, if you have had a fixed annuity for many years in an insurance company that has a bit better than average credit rating, should you look to move the account to a top-ranked credit rating agency company, even though that entails a new surrender factor?
I think that depends on how bad this insurance company you have this annuity with. I mean, if it's AM Best is the insurance company ratings. So if it's a one-notch difference, probably not. If the insurance company is having major issues and you want to have some safety there and up your notch multiple levels, I think maybe, but I just don't think this is an environment where government's going to allow these insurance companies to go under and not have their annuities paid.
Yeah, especially just because who the consumers of annuities are. I would be I would be less concerned about the credit rating of the insurance agency and more concerned about the widening spread of credit default swaps. Credit default swap is essentially an insurance policy on some entity. You pay a premium, and if they default, then you get some money back. If they don't default, you lose all the premium. So I would be more concerned with how the credit default swaps of that specific insurance agency is widening versus what the credit rating is for that company.
Yeah, but I probably wouldn't pay the surrender charge. Is there a sweet spot to assets under management when considering a management group? I don't really think so. I mean, some can get a lot, way too much assets and hard to manage certain funds. So that's why a lot of mutual funds close. But I can't think of a sweet spot off the top of my head.
I mean, it depends, right? Some
depends on the asset class.
Well, yeah, but also some asset managers, and maybe I'll take this from the context of who you should be thinking of to be your financial advisor. Some investment management firms are really good at managing only $50 million and cannot scale. Some have a couple billion and don't service any of their clients. So it's kind of it's a personal preference thing. How involved do you want to be within the management of your assets? How involved are they allowing you to be within the management of your assets? Are they out there to actually help you and answer your questions? I would probably attack it more from that angle than anything in terms of how big the firm is.
It says, I think I have better eyes than you, so I'll read them. Does your firm have access to alternative investments that an individual retail investor can't invest in? Do we have access to it? Yeah, we could invest in that, but I don't think that's something that we really want to do. To be honest with you, I think alternative investments are very overblown. They can kind of mark their assets to kind of whatever they feel like. So I don't really think it's something that most average investors should really get into, because they can't really do the proper due diligence in my mind.
Yeah, I agree. We get approached all the time. We had someone approach us a couple months ago wanting to hop on their platform to be institutional investors in funds that own sports teams, right? But that, it's more about what is right for your clients versus what sounds exciting.
And alternative investment is so broad.
It is incredible.
Alternative investment. I mean, there's so many. You're talking about private equity, private debt. Sports teams. I mean, there's just so much out there, and private REITs, et cetera. Generally, I think most private assets are extremely overblown. Alex says, do you use style boxes for rebalancing? Yeah, we will use, especially if you're looking at mutual funds within a 401k, for example. They might have growth funds and value funds, et cetera. And which side do we want to lean on, depending on liquidity situation, depending on trends in the market, et cetera. So yeah, it's a factor when we're looking at funds.
Yeah, and within our own personal strategies, our own firm-wide strategies that we manage too, right? We do proprietary sorts on the market, determining where they rank in terms of profitability, in terms of relative value, all these things that we do take into consideration when we're buying and selling securities.
Do you recommend corporate bonds to generate income in retirement over fixed annuities? How do you handle when bonds are called? Yeah, we do. We actually run a strategy called stable income. So we actually do like that as a way to generate income. Number one, they're liquid, right? If you need the money, you can get it. Fixed annuity, if you need $50,000 for whatever reason, health concerns, you want to help your child or grandchild buy a house or something, right? there's not that liquidity there. And so, and then fixed annuities, that's what they are. They're fixed. They're long duration assets. We talk all the time about you don't want long duration assets in an inflationary environment. Just look at bonds right now, right? The Fed cut rates, or bonds are going up. Why? Because there's more concern. There's more concern of inflation, stronger economy, nominally at least. And so you don't want those longer duration assets, and that's what a fixed annuity is. And that's why we buy corporate bonds that are relatively short in duration, talking 2 to 5 years is kind of the general time frame we're looking at right now. So make sure that corporate bonds are, I think, much better in this environment than the fixed annuities. You want to grab this one?
Sure. I was laughing because they're making it very big. So
they are making it very big.
Both of my children have a 529 plan, and both will have some money left after college. Both 529s are over 15 years old. How do you go about rolling that over to an IRA for both?
Open up a Roth IRA for them and make the rollover. I believe it's $35,000 each per lifetime. Double check on those rules, but that's part of Secure Act 2.0.
I think that's all we got.
Is that it?
That was our last question.
I think that's the last question. All right. Well, that pretty much is on time. We have 1 minute left. So we want to thank you all for tuning in, and hopefully you got a lot out of this. Help understand what your workplace retirement account is, how to analyze it, both on a plan level. Make sure you are pushing on your C-suite executives within your corporation to make sure that those plans are up to par for you and your needs and you and your colleagues' needs, as well as analyzing those investment options. That can be a challenge. You probably need some data. We use Morningstar, we use FactSet. We have a bunch of tools to do that, but you need at least one, I think, and hopefully your plan advisor can give you some pointers on that, some tools there as well. So thank you all for tuning in.